Hello and welcome to India Ideas, the weekly show which comes every Thursday at this time, focusing on different aspects, facets and features of the Indian startup ecosystem. I'm Gautam Roy. 2023 was the year of generative AI among startups in India and abroad. But another issue or attribute which stood out strongly was the need for profitability among these tech-oriented fledgling ventures. Startups stopped chasing growth at any cost and pounding the higher valuation treadmill to focus on some fundamentals, which is our showcase today. Profitability, or the path to profitability, was the buzzword for startups and venture capitalists in 2023. The ecosystem went very quickly from churning out a record number of unicorns in 2021, the actual number was 45, to just 3 in 2023. The slowdown and the increased cost of capital impacted, but parameters of evaluating the future prospects of a startup also changed from cash-infused growth and capture of market share to a principles-based sustainable business model which made profit, had good cash flow, and reinvested the money made into the business to grow it further instead of just looking at VCs for hefty checks or picking up loans. Let's talk about why it happened, how strong is this trend, and is it here to stay today? With Sukhmani Bedi, partner, Orios Venture Partners, which is one of India's leading VC firms. We have Ankur Bansal with us, co-founder and director BlackSoil, which is an alternative credit platform. And Mark Kahn also with us, managing partner, Omnivore, which funds entrepreneurs building the future of agriculture and food system. Let's start with you, Sukhmani. Good evening. You're relatively young in the VC business and have been on the entrepreneurial side as well in an earlier avatar. Now, how strong is the focus on profitability or path to profitability among VCs now? What's the approach of Orios Venture Partners these days?
I think the focus on profitability and path to profitability is definitely stronger in the ecosystem. Having said that, venture capital, especially early stage venture capital, is a business where we bet on new business models. It's a business of betting on future potential, on betting on risky businesses. So I think there will continue to be businesses which don't make revenue for some time to come, let alone profit. Having said that, what is important is that there's some defensibility which can be monetized in the future. I think there'll be a lot less compromise on path to profitability. I think one of the major contributors to this is that, there have been the demise of several business models which did not have a clear path to profitability and have not worked out. And I think the VC industry has internalized these lessons. As far as Orios Venture Partners is concerned, as a fund, we've always focused on sustainable businesses. We've always focused on businesses which have a very clear path to profitability. So not much changes for us. It's business as usual.
Okay, sounds good. Now, Ankur, BlackSoil is an alternative credit platform which is different from being a VC, but is profitability a huge criteria for your outfit as well when you consider funding any startup?
Yes, that goes almost without saying because, as lenders, we have a very different threshold of risk versus the VCs, right? We are looking at a limited return versus the VCs, we are looking for outsized returns. So for us, the sustainability is become extremely critical because we cannot have the same kind of loss ratios that a typical VC can afford to. Because they have some transactions which may even give them the entire fund return, which is not possible in a debt kind of a scenario. So like even in our current fund, the first fund that we had done in 2020, almost 80% of our portfolio is EBITDA positive. So that was done not because of, today everybody's talking about profitability, but in the last 3 years, we have been looking for those kind of companies where by design itself, we are looking for companies which are sustainable in nature. And of course, this has happened because of all the reasons in the last 2-3 years, the focus on listing in the markets, the profitability becoming extremely critical. So for us now, the funnel of companies that we can look at has only improved because now everybody's talking the same language that a lender is also looking for. That only underwriting loss-making companies perpetually become extremely difficult because the next round of funding, when it happens, how it happens, is becoming more difficult in current market conditions. So once you're EBITDA positive, debt becomes a very good use case because your growth cycles can continue. You can service the debt using the cash flows, which is obviously the narrative the traditional world is used to. But this is something the new economy world is also picking up very quickly. and is becoming not a sort of the thing to look at from even VCs, as well as the more and more founders are also figuring out that this is the way that one can sustainably grow.
All right. Now, Mark, Omnivore's focus has been, excuse me, Omnivore's focus has been on the agri-tech, food tech and climate sustainability sectors. Now, does the yardstick of profitability apply in a weighty manner in these sectors as well, or is the key concern here more fundamental as to how useful or disruptive is a particular venture's tech, product or services?
Look, the law of profitability and more importantly, the law of cash flow generation applies to every business. It's really a question of when in its journey that becomes relevant. You know, if you're backing some hard tech, right, companies building innovative satellites, right, the timeline to profitability is different than, for example, if you're backing a marketplace or a platform. I think really what happened in the period from, say, 2018 to 2021, 22 is that platforms and marketplaces that should be profitable in every unit transaction were sort of given, you know, this freedom to operate with growth at all costs. And I think that was a function of the zero interest rate environment and huge amounts of growth capital coming in at any cost into later stage transactions. And that obviously came to an abrupt halt in 2022. I think where we are right now in 2024 is very interesting. I think there is still risk capital that's willing to, you know, allow a deep tech and agri-food life sciences company a few years to innovate before expecting profitability. But that freedom is not being extended necessarily in areas like fintech and marketplaces and platforms, where if you're not unit economic positive, it never really makes sense. And so I think we've moved from this world where GMV mattered to this world where it just doesn't the same way. And so we're all adapting to that. I think the good news is in the agricultural sector, in the climate sector, companies were doing more fundamentally transformative work and have been able to make that path towards profitable unit economics happen much faster.
Great. Now, Sukhmani, the broad reasons for the shift towards profitability, or P2P, has mostly been cited as a general economic slowdown post-COVID and the high cost of capital. But are there other contributing factors as well, such as the issue of corporate governance?
You know, so I would say the largest contributor, which has led to the change in sentiment, is that the venture capital industry, which is a fairly young industry, has completed a cycle, so to say, right, with 15 or so companies IPOing in the last few years. What became abundantly clear is that the public markets care about profitability, or a very, very clear path to profitability. So I would say this has been, the single most important factor that's contributed to the change in sentiment. There are other second-order factors as well. So the funding winter, as they call it, has contributed to it. Like I mentioned, just right now, that the demise of certain business models, which did not have a clear path to profitability from get-go, has also contributed to the change in the sentiment. In my personal opinion, I think corporate governance has less to do with this particular factor. I think the larger factor is the public markets.
All right. Okay, so Ankur, the other telltale piece of information is about BlackSoil itself, which saw a 44% rise in investments in 2023. So the shift from VC money towards debt, why has that happened in your view? Isn't parting with equity better than picking up debt?
So primarily in finance classes, we are taught that equity is more expensive than debt. But again, it also boils down to the fact that, what is the use case? So as Mark was mentioning, if you're building satellites, you can't do it on the basis of using debt, right? It is a very different kind of a growth capital that is required, or risk capital is required for anybody to be able to, take that kind of a risk. So that cannot be done by debt. But if you're doing working capital, if you're doing a regular capex, you're setting up a factory, etc., then it cannot be done only primarily on the basis of using equity money itself, right? Because every time you grow, you need to dilute, and dilution is extremely expensive for investors. So depending on the business models, different kinds of capital needs are coming. And of course, with all the question about funding winter, avoiding valuations, avoiding equity rounds, more and more, obviously, demand for debt is increasing. But it's very important to understand that we cannot replace equity with debt. Debt has a very different use case. It has a very different risk profile. It's meant for companies where contribution margin positive is already achieved. It's more about reaching EBITDA break even or already on that path, right? And or it could also be for some structured situations where somebody is doing acquisition financing, etc., that you look for something like that. But it cannot be replaced using equity, right? So though the demand will increase, the market obviously is increasing. India is still a very small percentage of startups are using debt versus if you use global standards. There's a large potential for the market to increase, but at the same time, as my co-panelists have mentioned, that it's still an early asset class from an equity perspective. So debt obviously is a part of the entire business, so it cannot be ignored completely. So we
And
will
it'll
see
be
a lot
also,
more growth.
sure,
Yeah,
sure.
sorry.
Go
So
ahead,
we'll
go ahead,
see
go
a
ahead.
lot of, so the growth will continue to happen, but at the same time, it has to be measured from a investment lens perspective.
And Sukhmani didn't really see much of a point in my question related to corporate governance when it comes to investing in companies, but we've seen cases in the past, very recent past, where certain companies did not really keep up their end of where that bargain is concerned, and even questions were posed to global VCs such as SoftBank and others, P15 Ventures among them as well, as to what were they doing with these companies when things were not really being put across in the correct manner as the situation was on the ground. A different picture, rosier picture was painted.
No, so don't get me wrong. Corporate governance is very strong, very important, and because of what's happened in the last few years, it's become stronger. It's here to stay, and and VCs have taken sort of stock of this, right? And it's become, even if it was say number 2 or 3 in priority for VCs, it's now sort of top of mind. The point I was making is that I don't think corporate governance has had an impact on the profitability part of it. It's had other impacts.
No, in terms of making investment decisions.
Oh yes, of course, right? In terms of making, all of it has changed, right? Making investment decisions, the due diligence that goes in at the time of making investment decisions, as well as the due diligence that happens in the life of a fund, right? When you're interacting and working with your portfolio. All of it has changed. Corporate governance is, I think, stronger than ever and here to stay.
Mark, what's your view on this particular subject of corporate governance when it comes to investing in companies, and of course the debate on equity versus debt as well?
So I very much agree with Ankur on the debate of equity versus debt. I think there's a bit of a problem that's existed for a long time, which is that equity is used for too many things in the startup ecosystem. Right? In theory, you need money for 3 things in a startup. You need money for the J curve, the losses in the early life of the startup that you have to endure until you reach a size where you become profitable. You have working capital requirements, and then you have fixed assets that you're buying. Let's say you're building a factory. In theory, you want to use venture capital for the J curve. You ideally want to use bank debt for work, or something along the lines of bank debt for your working capital requirements, and term loans for fixed asset investments that will become profitable. The reality is, early in the life of a company, they're using their equity raise from a VC for all of that. And so the more that we can use the right sort of capital for the right sort of problem, the better we are. And it's been, firms like BlackSoil and others that have been able to at least begin creating debt options so that the whole burden is not sitting on the equity stack. And so founders are in fact over diluting to cover costs that should be covered with debt capital. With respect to corporate governance, look, we as Sukhmani said, we've come out of a business cycle, and the reality is the peak of a business cycle is peak stupid, right? It's peak valuation, it's peak inflows, and it's peak stupid. And there was a perverse set of incentives that were created by later stage growth investors, where growth at all costs were rewarded with massive increases in valuation, and huge funding rounds to generate more growth at all costs. And I think, when you have those incentives, everyone gets a bit dumber. Founders are no exception. And so I think, as soon as the funding environment tightened up, right, it's that saying about when the water comes out of when the tide goes back in, you see who's been swimming naked, right? And we discovered that there certainly were startups in India that were swimming naked, and people that weren't aware of their portfolio companies. I think it's a challenge that you learn from. This was the first real cycle that the Indian venture capital ecosystem had been through, if you think about it, since many, 20 years earlier. And so I think going forward, right, you will see very, increased standards, making sure these sorts of mistakes don't happen again.
All right. And Sukhmani, let's also talk about the days ahead now. How do you see the funding scenario going? Is it going to shape up? Because is it still going to remain tight, whether it's equity or debt, or as interest rates ease up through 2024? That's what has been forecast with the Fed and others. Will money become like confetti again?
So I don't think the heady days of 21, 22 anywhere near, right? So I don't think that's going to happen in 2024. Having said that, we are optimistic. I think that there's been an uptick in venture activity in the end of, the last quarter of 2023. So I definitely expect both in terms of venture capital deployment as well as IPOs. I expect 2024 to be a much better year. Having said that, I think there have been some changes which are more sort of systemic or permanent in nature and are here to stay. Just based on everything that's been mentioned in this discussion. So one is that I think valuations are definitely going to come down in the future, right? And I think this is one of the changes that is here to stay. In the last year itself, I think about 9 unicorns had down rounds in terms of valuations. Mm-hmm. So I think that is going to be saner, for the lack of a better word. And I think for growth stage startups, profitability is going to become an important metric, right? I think investors are going to demand it a lot more than they were in the past. So I think there are changes that are sort of here to stay. It's not, all of it is not cyclical. And I do think that 2024 is going to be a better year for the ecosystem.
All right. Now, Ankur, is there room for other alternative means of funding to also emerge in this scenario for startups listed in other larger legacy firms? If so many options, is a movement towards that sort of scenario also possible for startups?
So already, I think in the last 18 months, we have seen other forms of alternative capital, which has been obviously coming in. But as I mentioned, it always has either a color of equity or debt, right? So finally, these are the two primarily forms of capital. So the largest one that we have seen happening is on the convertible debt side. So a lot of the large growth stage companies have used convertible debt to sort of avoid raising a valuation-based round or price round, as they say. So convertible debt has been one very large source of capital, but again, not available to all the startups majorly. Second source of capital that has been available for early stage companies on some other forms of debt, which is like a revenue-based financing, where a percentage of a revenue gets collected for servicing of debt. So if your revenue is fluctuating, so is the sort of the EMI or the payments that need to be made to sort of your lenders. The third form of capital that we have started seeing, which is extremely, again, more equity than anything else, is some of the growth stage companies are still being able to execute US-based SPAC listings to sort of get equity. So they are formed waves where there are still a lot of SPACs which were raised in 2020, 2021. They're still looking to sort of deploy that capital. And we have seen like a couple of companies also go for listing in US, NASDAQ, SPAC. Of course, this is not necessarily the ideal way of raising capital, but when there is no other options, people obviously go across whatever opportunities are there for the companies to sort of ensure the business survives. So depending on your stage of the business, of course, primarily people will go for a straight equity rounds, which I think will happen more as sort of the businesses are coming up in better shape coming 2024. And or the regular debt options are there. But these are some of the other things that we have seen people use depending upon the stage they are at and the kind of options that are available at the point of time they're looking to raise funds.
Mm-hmm. And are we also going to see more and more people getting into the venture capitalist business as well? Because there was quite an explosion there as well. If you look at what had happened when funding was readily available, a lot of people became angel investors who were far more traditional earlier in their approach to investing, but things have changed. So will that be a trend that will sustain?
So I see that angel investors, people have realized that it is not everybody's cup of tea, right? Many solo GPs had come in, many people try to raise a VC fund. And it's also do with a lot of the flavor of the season, right? So 2021 startups were the flavor of the season, so many people were behind it. Today the public markets are hot, so everybody is again gone behind the stock market because you're making very quick returns. So there will always be ups and downs in every business cycle. But the people who have been doing this on a very serious way, in a way that they have been doing in a structured manner, they will continue to exist. They will continue to grow. There will be some zombie VCs who will not be able to raise capital. There will be first-time fund managers who will not be able to raise capital. But funds who are able to show track record, especially in current market conditions, will really stand out. And I think that's what at least all the serious players are banking on, that their portfolio quality will actually stand out in front of their investors and they'll be able to raise much larger capital. But the market is obviously going to expand, and as the market expands, more players will come in. This has happened already in debt. When we had started off, we were possibly the third player. Today, there are reports there are maybe 15 players in the market, and it'll keep growing, which is great, good for the ecosystem. That competition obviously keeps more options for all the players in the ecosystem. So I think we're in a very great position as an ecosystem where we are, where more and more players coming in. And of course, the ecosystem has become so large, even so many, the founders also are becoming VCs, they're becoming part of this ecosystem. They have seen businesses being built. So it's actually quite healthy where we are today.
Wonderful. Now, Mark, if funding is to further evolve and move towards maturity in India, what other changes are needed in the ecosystem, not just where funding itself is concerned, but also how startups do business, or even if they fail or flop, how do they, down their shutters?
Look, I think the process of downing shutters has actually come a long way with reorganization and bankruptcy law over the last few years.
Yes, the IBC is there.
Yeah, so in contrast to a decade ago, I think that's well understood. I think the biggest trend that needs to happen is companies coming to public markets sooner. And obviously there are rules around that. But whether it's for an SME IPO or a full-fledged IPO, I think this notion of relying on late-stage growth capital to stay private forever, that needs to change, and it's already changing. You see with the success of the IdeaForge IPO, you see this in multiple public offerings that are being lined up now. This notion of staying private forever, which had sort of infected everyone over the last decade, that's the biggest change that I want to see vanish, right? Or that's that I want to see.
Yeah, in fact, now that the longer you stay private and sort of dither on coming into the public market, the more people doubt how soundly is the company being run.
And I think so. I think it's also very important, as I've said on here before. I think widespread equity ownership in the most transformative companies in India is something that we all want as a society. And so I think the sooner these companies can go public, the better for everyone.
All right, wonderful. Well, great speaking to you all about this trend which seems to be here to stay, and we will see further refinement in it as well, where the concern for profitability or path to profitability for startups is concerned among VCs and others as well, because there are so many ways of raising funds too now, and we will see further evolution in this particular aspect of our startup ecosystem. Thanks for joining for this evening and talking about it.
Thanks for having us.
Thank you.
That's all we have for the moment in this edition of India Ideas. Do let us know what you think about the show every week on Thursday. We're on air at 8 p.m. IST and 2:30 p.m. GMT. And keep watching DD India for all the latest.